Did you know that our mood can affect not only how our day goes, but also how the stock market performs? What if I told you that Mondays and Fridays are not just normal days in the markets, but have a hidden effect on the returns of speculative and quality stocks? In this video, I share with you some fascinating insights from a research paper that literally had me glued to the monitor. We'll see why quality stocks do significantly better on Mondays than any other day and why investors' attention turns to speculation on Fridays. Get ready for a combination of psychology, global markets, and investment anomalies that is not commonly talked about. I recently came across a very interesting article on Science Direct by Marda, Chiah and Zhong called Day of the Week Effect in Anomaly Returns. International Evidence. In the article, the authors discuss whether the so-called day of the week effect, i.e. systematic variation in stock returns depending on which day of the week is traded, also exists for so-called anomalies in international stock markets. Specifically, they focus on the return difference between quality and speculative, so-called junk stocks, as measured by the quality minus junk (QMJ) factor. The authors build on earlier work by Burr, 2018. Which showed that speculative stocks in the US market have significantly worse returns on Mondays, but better returns on Fridays. This is explained by changes in investor mood. Indeed, psychological studies show that people are generally in a worse mood on Mondays, while they tend to be more optimistic on Fridays. And speculative stocks in particular are particularly sensitive to investor sentiment because they are uncertain, difficult to value and often similar to lottery tickets. They are therefore more an object of emotion than rational analysis. Chiah and Zhong have taken this principle and applied it on a global level. They wondered if a similar effect existed outside the US. They used the QMJ factor, which differentiates the speculative and non-speculative parts of the market quite accurately by the difference between high-quality and low-quality stocks. Quality stocks tend to be stable, profitable, well-managed and easy to price. Junk stocks are the opposite: volatile, often ex-dividend, financially uncertain. Their analysis covers 24 international stock markets, and the results are surprisingly consistent. On Monday, the QMJ factor shows a significantly higher premium, specifically 2.89 times its average daily return. In other words, on Monday, quality, i.e. non-speculative, stocks perform exceptionally well compared to speculative ones. But on Friday, the situation reverses. Investors are more optimistic and more confident in speculative titles, so junk stocks generate higher returns. In addition to QMJ, the authors also examined the momentum factor, UMD, which has neither a clearly speculative nor a non-speculative component. The results showed that there is no systematic day of the week effect for this factor. This, according to the authors, confirms that sensitivity to investor sentiment is the key explanation for the QMJ effect. Overall, I was really intrigued by the paper. It shows that psychological factors such as investor sentiment during the week can have a measurable impact on stock returns, and that this effect is not limited to the US, but has global validity. It also provides further evidence for the theory that the differences between quality and junk stocks are not just a matter of fundamentals, but also of mispricing caused by investors' emotions and biases. For me, as someone who is interested in the behavior of markets and their psychology, this was a really enriching text. As you just learned, even something as trivial as the day of the week can have a surprising impact on investor behavior and market returns. The study by Chiah and Zhong shows us that speculative and non-speculative stocks react to changes in investor sentiment during the week around the world. And if we know this, we can start to work with it, whether in developing strategies or interpreting market movements. If you're interested, let me know what you think in the comments, and don't forget to like and subscribe, because we'll be uncovering many more similar connections between psychology and markets in future videos.